When you write trading tips for a blog, you often wonder if people will read them and act on the information that's presented. Now, receiving emails, it's a great way to know that you're actually contributing to the trading world in some small way. And I received an email from a reader named Devin, and it was in regards to support and resistance trading. Shane, I've seen many of your trading blog posts and I think they're terrific. My question, however, is that I see trades around support or resistance areas and you never take them. I've also seen you trade right into a support or resistance level. Since multiple hits of a level make it strong, why do you skip them? And I'm going to respond with, thanks for the email, Devin. Over the years, I've lost count how often I've heard that multiple hits on a support or resistance level tends to make it stronger. Now, some trading systems and methods actually use this belief as the backbone of the method. Stronger is certainly a matter of opinion, and what some may consider strong, others would consider weak. So the question is, how do you measure how strong a level is? What measurable variable do you use to tell the difference between a strong hold and a weak hold? Many traders would have totally different opinions on which S&R levels are good ones to trade. When I look at an area that has held price, what matters to me is how long price has hung around at the support or resistance level. Fast rejections due to buying or selling pressure is something that I would consider strong. If price tends to hang out at a level or rejects and then quickly returns, I think it's safe to suggest a lack of buying or selling interest. And I think it's a dangerous practice to simply assume that multiple hits and rejection is a direct relation to strong levels. What occurs quite often is a confidence booster that in the end causes some oversize in the loss department. And this graphic should explain. There's obvious buying pressure at the levels that are marked with the arrows, and you can clearly see that the buyer stepped in quite strongly. Now keep in mind that those who trade support and resistance bounces usually place their stop just beyond the level. These are solid rejections, which can oftentimes lull traders into trading too confidently and increasing their position size. The more traders that buy at this level, the more stops tend to cluster beyond the level. The red line signifies where all the textbooks would tell you to place your stop when utilizing support trading. It's a disaster waiting to happen when the level breaks, stops are triggered, and slippage is a strong possibility. Even worse, the losses a trader will take depend on how aggressively they increase position sizing because they knew that the level would hold. But there is a clue that shows the conviction of the buyers is beginning to slacken and a heads up for you to adjust position sizing or skip the next trade. Notice the black lines plus the letter L. There were strong rejections at the support line, but the excursion away is lessening. The last push even had an extremely bull candle showing some strong upwards momentum that stopped right in its tracks. Now notice the far right of the chart that when the price broke support level that had multiple direct hits, it broke with strength, taking stops with it. Now I don't trade support and resistance bounces as seen in the chart. I prefer bounces and a pullback because my experience for myself and through many trades, playing the bounces as shown just don't have an edge. As well, I'll be also interested in flushes in the support and resistance zones. This way of trading, for me, applies to day trading and swing trading, and it's valid on any time frame. Now, these are not trades that are blindly taken, and they also revolve around trend direction, state of higher time frame, not necessarily the trend on the higher time frame, and overall context. Now, this chart highlights roughly what I would look for. Price had just slammed through an area of resistance, now marked former resistance, and pulled back, and price was supported, marked current support, where price moved away to the previous high. The pullback to the current support was anything but strong because the candles, they tell the story, and we can see a test of current support where price breaks it and is quickly bought back. I marked that as a flush of weak longs given the preceding price action. That is a sloppy test, but it might be a trade for me. Now imagine for a moment that price did not flush, but continued upwards after the bounce as seen on the chart. The pullbacks would come into play as ways to enter this move. Now there are various ways to enter pullback trades, but that's beyond the scope of this tip. Now I believe every trader should take what they've read and seek to verify the validity of the content through their own testing. Reading and being taught, it's one thing, but I've always found that the testing phase of any market truth, quote, much more valuable than what I read or what's been taught. Now, if you found success trading support and resistance as taught by the book, I applaud you. I just personally have never found validity in trading it the way that it's normally presented.